We're going to start today's conversation with Yanai Oron, General Partner of Vertex Ventures. Yanai, welcome to the show.
Hey, thank you. Welcome from Tel Aviv.
Tell us a bit about Vertex. Tell us about yourself. Let's introduce you to our audience and also let's get to know you.
Sure. So as for me, I started as I lived my whole life pretty much in Israel. I grew up in Israel. I was an electrical engineer and worked for Intel for a couple of years, working here in their Israeli R&D center, which is pretty big. And then when I wanted to switch to the business world, I wanted to live in New York, so I went to study at NYU at Stern, and I did my MBA there, after which I worked for a mid-stage startup doing business development and then management roles. And during the time, I lived in New York for about 7 years. And around 2010, I decided to go back to Israel and be back with my friends and family. And this is also when I started to go into venture. So I started as a small angel investor. These were, in hindsight, very good years to be an angel investor. It was still, not a lot of people wanted to invest, but these were probably the best startups were founded then, so I had quite a nice fortune to invest in some interesting startups. And about 3-4 years later, I joined Vertex as a partner. Vertex is a 20-year-old fund based in Israel, and we are an early stage fund managing around $150 million US each cycle, investing in early stage, which is a general word for anywhere between large seeds up to small B rounds. The unique thing about Vertex is, except the fact that we are a standalone fund in Israel, Vertex itself is a network of funds, Vertex Israel being one of them, but also there's 4 others in major hubs of innovation throughout the world. So there's one in Silicon Valley, one in China, one in Singapore that invests in Southeast Asia and India as well. Which means that we have a presence in most places of innovation throughout the world, or similarly similar in size funds, each investing in its own locale, specializing in what the local scene has to offer.
And when you say you like to invest in seed, can you define what is a reasonable set of proof points or validation that you're looking for before you're willing to put in money in a company?
Sure. So actually, it's important to say that we're pretty flexible and we don't do only seed. So our sweet spot is a $150 million fund. I guess in the US or in China, that would be a seed fund. For us in Israel, because the market is actually smaller, that's a typical A-round company. Even though today the boundaries are getting more less strenuous. So our sweet spot is probably A rounds, okay? But we more and more see ourselves doing some going upstream and doing earlier rounds. On one hand, simply to get a significant percentage at the company before it gets very expensive, but also because I think today what we're seeing in Israel, and it's probably similar to some other place in the world, but we would not do a small seed. So if a company raises $500,000 or $1 million, if it's a B2C, if it's an internet, something that you can get a proof of concept fairly easy and get some traction, that's probably not where we are best at. That we would leave that to angels or actual seed funds, which in Israel usually are 30 to 70 million US. We would participate in seed, and that can be just an idea. If we really know the founder or believe that they are very strong founders, we are very comfortable investing in the presentation phase. So just an idea, but a market that we're really confident on, but also where there's deep technology to be developed. So it's not something you can develop in 3 to 6 months and get an MVP out. It's usually something that takes a year or so, depending on what kind of technology. And then we would make sure that the company has at least 2 to 3 million, and sometimes we also participate in seeds of 6 to 9 million, enough money for the company to, 1, develop the product, and number 2, get some initial traction so they're ready for the next round. And in which case we usually would sometimes partner with other funds or angels
So it's interesting because actually your comment that in the U.S. your fund would be called a seed fund is not correct. I think in the U.S. also 150 million fund is still a Series A fund, seed Series A fund, but it's a fund that is structured to be able to make smaller Series A's, because a lot of the traditional venture funds in the U.S. right now are so large. Their Series A will need to be a 5 million to 10 million Series A, and that's, to get there, you really have to, that's, in the traditional terms, that's a Series B or Series C company.
Yes. Yeah.
As a result, there is a lot of smaller funds that have come into the market who are willing to do the smaller Series A, the 1 million, 2 million, 3 million Series A's, and that's more where you are positioned, it seems.
Well, actually, so I think just to comment on that, and once again, I think the definitions get so different also between geographies, but also, so we actually see a Series A as something that is 5 to 7 million, but we've gone to see some Series A that are 12 to 20 million, right? And and more often we see seeds of this nature. So it's a little bit confusing. So it's hard to really say what's seed and not. And it's not about really the money. It's about which, what's your target? What area are you focused on? Are you getting to? Can you do something within 3 to 6 months, or do you need to develop something that will take you a year?
Yeah. Well, and the other corollary of that conversation, audience, is that it's very difficult as a first-time entrepreneur to get people to write big checks. So if people are looking for entrepreneurs they know, people are looking for entrepreneurs who have done it before. If you're a serial entrepreneur with track record, you may be able to get money to build something from investors, but if you're a first-time entrepreneur, that's a very long shot. So just be aware of that as you plan your funding. So Yanai, let's talk about market segments. Where do you like to invest? What markets are of interest? B2B, B2C, both? What parts of those? Let's deep dive a little bit into the markets.
Sure. So we're generally a B2B play, and I would say our investments are about. You can put them in two major buckets. The first bucket is can be categorized as enterprise software, and within that we include all the classic enterprise software, so marketing technology, sales technology, infrastructure. Israel has some very interesting infrastructure companies to come out of it, storage,
security,
cloud infrastructure, and cyber obviously is a big one, and that's also under enterprise software, and that'd be probably half of our investments. And really, that if you look at Israel, it's kind of what's the bread and butter in Israel is those teams. Main reason for that is because we have anywhere between 200 to 300 multinational companies who set up an R&D facility here. So a lot of Israelis who've gone through either MBAs or worked through these companies, they understand the culture and they understand kind of what it takes to create the next generation of whether it's storage, cyber, or marketing technology. Obviously, cyber, we also have a unique set of skills because our army creates a lot of technologies which can later be on the use. So that's the enterprise software. But I think more and more the other half of the investments we make are kind of emerging sectors, which in the past were always kind of a one-off, but today we see different areas that have become really interesting for startups. And those would be, some are already kind of at their biggest hype cycles, like automotive, to some extent insurance technologies. And we've been very active with those in the past, and those have paid very well for us as well. And now we're kind of looking for the next stage, and including agriculture technologies, retail technologies. We're starting to look at construction technologies, and the main area and the main characteristics around those investments is companies that can bring very deep technology, a lot of machine vision, a lot of big data, a lot of analytics. In the past, it used to be scary that it would be very hard to work with the large corporations in these areas. I think we've seen over the last mainly 3 or 4 years that the automotive company, the insurance company, the retail companies are more than willing to work with these early startups. Doesn't matter how early. Sometimes the earlier the better. Okay. They are to some extent concerned about maybe Amazon or some similar or high-end companies kind of reaching out and disrupting them. And we see two types of companies. One, companies that actually try to disrupt the incumbent, but the second ones, which actually we see more of, and it's the easiest to do, maybe not the largest outcomes, are ones that help them create automation, help them improve their processes to be able to kind of progress to the next era of customer experience and fighting these new incumbents.
And what are some of the highlights of your portfolio?
Okay, so previous interesting companies that we had the fortune to invest in were company called CyberArk. It's a cybersecurity company traded in the NASDAQ today with valuation of around 1.7 billion, helping companies secure their privileged information, which is usually what hackers are looking after. Another interesting company that we invested in early stages is a company called SolarEdge, which is a company that creates technology for solar panels, also trading with over $2 billion in the NASDAQ. A third company that we had the fortune to invest, which was a very interesting ride, is Wave. Even though we don't do a lot of B2C, that was a very unique story that we thought could end very well, and it actually did. If you look at our current portfolio, this year we had a very interesting exit with a company that did cybersecurity for automotive. It's a company called Argus, which we funded only 3 years ago and was sold for around $400 million to a European company. This is an interesting story because 3 years ago we were not sure even amongst ourselves that cybersecurity for automotive is a real need. But it quickly, as autonomous vehicles became a real thing or just approaching to be a real thing, the need kind of presented itself, and this was an amazing ride. It was shorter than we thought, but we really like the company, and we're actually seeing a lot of other companies because the need is really big.
Interesting. Now, if you look at the 2017, let's say, year, 12 years of 2017, a couple of months of 2018, what trends do you see in your deal flow?
Right. So, and this may be a little bit, well, probably not unique to Israel. It's just that we see so many deep technology driven companies. Okay. Yes. So we see young entrepreneurs that don't necessarily have a lot of business experience, but come in from very technology driven experience, and they kind of say they're able to now look at, okay, what's interesting in the world? What are interesting markets to look into? They can spend 2 to 3 to 4 months exploring, very deep exploration of the field, and come up with some crazy ideas. And when we see them the first time, it's pretty crazy. When we see them a month or two after, we're already competing after the deal with maybe 2 or 3 other venture funds. So the cycles for the crazy ideas have become very quick. And we already, after investing in some of those companies and seeing what happens a year or two after, we're already seeing how quickly, the wild ideas are becoming reality. Not only because the technology allows them, which is obviously a big thing, because vision, deep learning and vision-based technologies are enabling stuff that we could not have imagined 5 years ago, but also because of the willingness of, as I mentioned, the large corporates to work with them, which is pretty amazing. So companies today, they can create the technology, which is pretty difficult, but we can speed it up and can be within a pilot within 2 months of, sometimes they still haven't formed the company and they're already starting a pilot with a major corporation. It's pretty amazing.
Yeah.
And that would probably be the one major trend we're seeing.
And would that be in any particular sector, any particular technology area, or across the board in deep tech?
Right. Yeah. So if I look at the last 3 years, we've invested in 3 automotive and mobility related companies, and we've seen that progress. The large car companies, from being very hard to work with, thinking with 7-8 year cycles, have narrowed the cycles, are very quick to work with companies, are very eager to fund and sometimes acquire companies. So that company, that is kind of the blueprint of what we're now seeing in beginning to see in insurance technologies, even though that sometimes takes some time, depending on are you doing marketing stuff or are you trying to actually change actuary numbers. Retail has become exactly that. There's some very interesting programs in Israel, which I'm sure we can find similar ones in the other places, of large corporates creating commercialization programs. So not accelerators, but commercial. So they're not, so they would sometimes look for early stage companies, but sometimes late stage companies. You know, Microsoft is a big one. You know, the Microsoft Accelerator, which they've now changed to the, you know, the scale. I'm not sure the exact name, the Scalerator. They're looking for companies who already have products, but are very quickly willing to work with them and bring them very deep within the organization. Also teaching them, especially teaching them who in the organization are the right people to speak to, which is sometimes the hardest thing for
very hard. And a company like Microsoft is extremely hard.
Not as much today, really. They've really changed. I mean, definitely with Satya, but also kind of, and I think the Accelerator, the big, you know, big contribution to this. Okay, we saw it kind of firsthand. We know some of the folks who are running this program. They completely changed their view on how to work with startups. About not we're helping the startups, but we're going to learn from startups kind of where is this thing going. And if they adopt our products, then it's going to be pretty easy for us to then sell it to the other ones as well. But to go back to what I started with, so retail has become extremely amenable to working with new companies. Retail companies, which as far as 5-6 years ago, we would not touch a retail-based company because we would say you would run out of money before you get your initial pilot. And that's completely changed, 180 degrees. So that's one. Construction is beginning. You know, we're still kind of trying to figure out whether it's working, but these are all in the emerging sectors. I'm trying to think within the enterprise software market, the major trend there, if I look at 2017, is that's actually a harder one because what we see is bigger companies today, you know, the Amazon and Facebook, those are becoming harder to compete with. You know, we're seeing the kind of speed that we are used to from startups with these large corporations. So we're not as likely to find a small company doing a developer tool, you know, for Amazon serverless. I mean, there's plenty of other people doing it. We're not as happy to do that because it's pretty scary to see what these big companies are able to spin out in very quick turnaround time.
Now, are you looking for billion-dollar TAMs only? Is that your sweet spot? Or are you also looking for companies that are working in more niche areas, perhaps with smaller TAMs, but with deep technology that can really be the market leader, maybe own 60–70% of a market with a, you know, smaller TAM?
Right. So our DNA is the billion-dollar TAM, and it's very hard for us to diverse from that. In some cases, we try to think whether do we really understand the TAM? Is it even possible to assume that, or this is such a new market that it can be easily developed into that? And we are okay with a $200–300 million outcome if it ends up being a smaller market than we thought. I can give you one example. This is fairly recent, so it's maybe a biased example. So we invested in a company called Cryon. It is a company that does RPA, which is robotic process automation. This is, many people haven't heard about it, even though it's kind of a big deal now with enterprise. The idea is that enterprise, they want to cut costs, and they want to do it by automation, okay? And they used to do it with very long and costly business process management with large vendors like IBM, Software AG, and SAP. These will be very long and very hard to work with. And a lot of times the CFO says, you know, yeah, I'm going to cut costs, but it will take me 5 years, so I'm not going to see ROI within the next 3 years. So what RPA does is it says, let's look at all the manual tasks that each employee does. If you think about maybe an insurance company, think about someone taking the claim, copying it to another ERP system, and then running a few emails. Most of that task, most 80% of that employee does is manual tasks that can be done with software. And the idea is that it's hard to integrate to these legacy software system, and it's hard to replace them. So what RPA does, it mimics the worker, even sometimes being on the same machine, through the GUI layer. So it actually understands the GUI and it does it. And what you can achieve is with little integration, you can get, you can increase the capacity and reduce errors, okay? And then if this is a process that is customer facing, you can actually improve customer experience as well. And you got all of that with half the cost, half the time. This was until 2 years ago, this was seen as kind of like a niche product. This is not real automation. It's maybe a pass-through or a transient technology. But what we're seeing is because enterprise is so complex to really change, this can take a long time. And having a real solution that can automate stuff is something to stay. And this, we've seen the market grow very fast. But still, many of our counterparts believe that this is a small. It was at the time. This was a year ago. Estimated this is a $200–300 billion TAM. Okay, but what we're seeing, this is a 40–50% growing. But also, we're thinking this takes a big part of the, $7–8 billion market of BPM. Okay, so we saw it's growing very fast. We didn't know exactly, and we're already 8 months in, seeing that. It's taken a big portion of it. So that's one way of saying, we really don't understand. A lot of people don't. Some analysts actually said that, some didn't. So we're willing to take that risk. If the company, and the company was growing very, 100% year over year, it's stuff that is very to see, but I know that a lot of other VCs have kind of looked and not invested in it because of TAM, simply.
Yeah. Right,
so
right, and that's exactly where my question comes from, is that, we are in 2018. There's a lot of stuff that has already been built in all different areas of technology. So right now, there are not as many billion-dollar opportunities, but there are many opportunities that are in that 200–300 million TAM kind of range. And in a way, there are ways to make money off these opportunities. You build it up to a point, and you then, flip it maybe a little bit earlier than you would perhaps on the other side. You can do 3x, 5x on these deals. So my question comes from exactly that observation that, and some of the funds that we're talking to are, kind of making that call is that, okay, we can do smaller TAM deals. We don't have to only chase unicorns. Because part of the issue also is that there are 700 seed funds, micro VCs and seed funds here right now in the industry. If everybody's chasing unicorns, everybody's chasing billion-dollar market opportunities, there's just not enough of those. So you have to find investment pieces to play.
No, but once again, this is very hard for me to say, and many people will not come out and say this loudly, but once again, so when we look at companies, I'm okay with that being kind of the, if 200–300 million, okay, is the kind of safe bet. Once again, if the company succeeds, and obviously the percentage, but obviously I still need to return around $450 million to my investors. If I look at a company and I think I can get 20–30 million out of it, best case, it's a hard thing for me to adjust.
Of course, your fund size determines those. So there are. Yeah. And audience, just to, I know you are probably getting a little bit confused because this discussion is quite sophisticated from the point of view of how venture capital works. For, for a company to be interested in a 20–30 million exit for a VC firm, they need to be a very small VC firm. But the point is, but there are a lot of those funds in the market right now. There are a lot of $15–30 million funds out there who are structurally equipped to be able to do those kinds of deals. $150 million fund like Vertex is not in that category. So that's at the same time, Yanai, you can do stuff that an NEA cannot do because they're a, billion-plus fund. So there are each of these structural points need to be taken into account, entrepreneurs, as you are thinking through your investment raising strategy, the fundraising strategy. Okay. So what are your other, points that we haven't covered in this discussion today that you would like to communicate to our community of entrepreneurs who may be interested in working with you, Yanai?
Sure. So I think one of the issues that we've seen entrepreneurs grapple with sometimes is the kind of the funding strategy. I cannot stress enough that funding strategy is critical. You can get the right product, but you can get the right people, but if you kind of miss your mark, or even if you did exactly what you thought, you still might come and realize that you haven't raised enough to get you to the next round. And the absurd is, even though there's so much money looking for companies right now, as you said, each fund kind of looks at some things and is going, is looking for certain things. So if you raise money but not enough to get to the A, that's a shame, okay? Now, there's always solutions. You can always go to kind of second tier. I mean, there's other funds out there. We also did sometimes, we could do a post-seed or a pre-A if we really like the team, but it's not the natural fit. We kind of have these buckets that we really like, and it's a big part of the momentum. So I think a big part of what we want to do with entrepreneurs, if it's first time, as I mentioned, we do that. We kind of try to really plan out what's the funding strategy. If you actually still miss it, okay, or it just wasn't, or sometimes that's not the case. I mean, you want to raise $2.5 million as a seed, but you can only get to 1.5. That's also okay. In that case, what I would recommend is looking for companies that are instead of going after a big party round. Once again, if it's a possibility, going after maybe one or two major investors, in which case they can work with you and they kind of have the responsibility with you to carry you through, that crunch. Okay, so they can do a follow-on. They can bring in some additional investors that count on them. Okay, that's very critical. But because sometimes what we see is, as an A round company, sometimes we see companies that did 2 to 3 seeds, not very good terms. They carry, they gave out so many percentages. They already have some big convertibles on their balance sheet, which makes the A round very tough. So instead of doing a 5 to 7 with a 20 post, it could be 10 to 12, 30 posts just to get to the same percentages that we'd like to carry. So once again, this is not something that, so you focus on product market fit because that's really what it's about. But if you did everything right on that and still kind of miss the funding, your outcome can change so much, because then you have to settle on which type of investors you choose. So funding strategy is probably the one thing that I would recommend looking into very strong.
And it's very complicated. Thank you, Yanai. That was very interesting conversation. Thank you for participating, and hopefully we'll have a chance to do some stuff together.
Thanks for having me.